Think forward. Think Research Channel.
The opinions expressed in the following program are strictly those of the speaker. They do not necessarily reflect the views of the National Science Foundation.
From the National Science Foundation, where discoveries begin. This is Frontier. Discussions of today's most exciting research subjects by distinguished scientists and engineers working at the frontiers of knowledge.
I'd like to start by thanking Mike Reichman, Kishan Baheti, and the National Science Foundation for inviting me here today. It's both a pleasure and a real privilege to be delivering this lecture, particularly because this is from the Engineering Directorate, and as Mike mentioned, my affiliation is actually with the Sloan School of Management, not with the School of Engineering. Now, as many of you know, MIT is a real engineering powerhouse, and I first heard about MIT when I was in elementary school because my older sister was an undergraduate at MIT. And I remember very, very vivid memories of visiting MIT as an elementary school student and being extraordinarily impressed with virtually everything about it, including the pinball center and the student center. But what really got me about MIT, and ultimately what drew me there, was something that my sister told me at the time. She said, you know, MIT is such a quantitative place that all of the buildings at the institute are numbered, and people refer to the buildings not by their names, but by their numbers. And moreover, the numbers actually have a logic to them. And I said, well, what is that logic? And she said, well, you know, from what she's learned as a freshman, she said that the numerical value is inversely proportional to the standing of the department that's in the buildings. And so, for example, Building 1 is the President's office as well as the mathematics department, mathematics, the queen of all sciences. Building 2 is physics, and I think electrical engineering, computer science is Building 3 or 4, and on down the line. And I thought this was a terribly logical way of arranging your construction. And I remembered that. So years later, when I was being recruited by the Sloan School of Management, I was very excited, talked to the dean, and was ready to accept the offer. And I asked him at the last minute, I said, can you tell me what building are we in? And he said, building E52. So that was a bit discouraging. But nevertheless, the reason I decided to join was because financial engineering had been pioneered at the Sloan School by the folks like Paul Samuelson, Bob Merton, and many others that came before I did. And so it was certainly with a degree of concern and alarm that when the financial crisis broke, I came across all sorts of commentary from various quarters about how quantitative methods are responsible for this crisis, and that financial engineering is the root of all evil, and that we should kill all the quants. And at first, my reaction was puzzlement, because it seemed to me that blaming quantitative methods for the financial crisis is sort of like blaming accounting in the real number system for accounting fraud. You don't want to blame the methods, you want to blame the people that are using the methods inappropriately. So I decided to try to dig in a little bit more at what the underlying causes are of this kind of financial crisis. Now, I'm sure that many of you have heard much more than you want to hear about financial crisis by now. So what I thought I would do today in the next half hour or so is to provide a somewhat different perspective on the crisis. I'll give you a very quick overview of it. I've actually now been able to compress the entire crisis into one slide. I'm very impressed about that. But then I'd like to dig in a little bit and focus specifically on the financial technology underlying the crisis. And I use that term very deliberately because I will argue that technology is ultimately at the root of all crises, in all disciplines, not just financial. So in order for me to make that case, I need to illustrate to you in extremely concrete terms and excruciating detail exactly what the technology is. So we're going to do that. We're going to do a little financial engineering. And after I illustrate it, I'm going to turn to the second theme of the talk, which is how crisis gets created when technologies can get ahead of the human abilities to manage them responsibly. So with that as the introduction, this is the crisis in one slide. As many of you know, the crisis really had its roots in the US residential real estate market. In the 1990s, we had a low interest rate environment. We had an ownership society where people were encouraged to buy homes. There was a lot of building. And so mortgages were issued for all of these homeowners to buy these homes. Then these mortgages were repackaged and sold to other investors. And many of these investors were banks, money market funds, insurance companies, pension funds, and so on. And ultimately, when interest rates started to go up and housing prices started to come down, these homeowners could no longer afford to pay these mortgages, and they defaulted, and those defaults caused a cascade of defaults among banks, insurance companies, and money market funds, to the point where there was a general loss of confidence by the public, and the government had to step in, which is where we are today. So in a nutshell, that's the crisis. But the much bigger question is, how could this have happened to us, one of the most sophisticated financial centers of the world? How could we have succumbed to these kinds of temptations? Now, I don't know how many of you watch CNN regularly, but right around the time of the Lehman Brothers debacle and the beginnings of the crisis, CNN started a segment that they called the Hall of Shame. And it didn't last very long, but during the week or two that they featured it, they would actually show the images of individuals that they felt were responsible for the crisis. So for example, Dick Fuld, the CEO of Lehman Brothers, was featured prominently in the Hall of Shame. I think he was public enemy number one. They had Christopher Cox, the former director of the SEC, and others. And they stopped this feature shortly after they started, and I think the reason they did so is because ultimately they ran out of room for the Hall of Shame. Because pretty soon they figured that everybody ended up in that Hall of Shame. And if you actually did an honest job of trying to trace the ultimate culprits, well, here's the list that I've compiled so far. You can blame homeowners, commercial banks, investment banks, mortgage lenders, brokers, services, trustees, credit rating agencies, insurance companies, investors, regulators, government-sponsored enterprises, and ultimately politicians. Every one of these groups can share some of the blame. And it's not to say that it's all the same and everybody was equally responsible, but the fact is that this financial crisis that we're in is quite a bit more complicated than it may first appear, and there isn't a single smoking gun or a single culprit that we can arrest and put in prison and be assured that we won't ever have to deal with this again. So in particular, what I want to focus on today is the role of the quants, or models, and make the distinction between models and mania in trying to understand the ultimate sources of this crisis. Now, as I said before, to do that, we need to go through a particular example. So I hope you'll bear with me. For the next 5 or 10 minutes, I'm going to drag you through a very simple example, but in gory detail, about a particular financial technology that is absolutely critical for the crisis, but it's also critical for the wealth and growth that we've experienced over the last couple of decades. And it's a brilliant innovation in financial engineering. So before I do that, let me describe to you what the problems were in the financial markets as a kind of a motivation for this innovation. So obviously, lots of lawsuits are being filed even as we speak about the crisis. And surely there was wrongdoing that needs to be brought to light. But so it's very hard to actually get anybody to say what happened and how it happened and why it happened. But it turns out that in August of last year, The Economist magazine actually published an anonymous article, which is very unusual for The Economist to do. They published an anonymous article by the chief risk officer of a major financial institution that's in the midst of this crisis. And this anonymous chief risk officer described a bit about what happened and what the circumstances were. So let me just read this to you quickly. There'll be some words that you won't understand, but after I describe the simple example that I'm going to give you, you'll understand it completely. Like most banks, we owned a portfolio of different tranches of collateralized debt obligations. I'll explain that in a few minutes, which are packages of asset-backed securities. Our business and risk strategy was to buy pools of assets, mainly bonds, warehouse them on our own balance sheet, and structure them into CDOs, and finally distribute them to end investors. We were most eager to sell the non-investment grade tranches, and our risk approvals were conditional on reducing these to zero. We would allow positions of the top-rated AAA and super senior, even better than AAA tranches to be held on our own balance sheets, as the default risk was deemed to be well protected by all the lower tranches, which would have to absorb any prior losses. Now, that sounds like a lot of gobbledygook, but what I want you to take from this is the simple fact that this particular institution, which got into a lot of trouble with these securities, their strategy was to hold the AAA or better than AAA stuff and to get rid of the lower than AAA stuff. What all of that means, I'm going to make clear in a few minutes. Okay, so just keep that in the back of your mind. And now let me turn to the example. This is going to be an example involving the magic, the technology of financial securitization. This really is a genuine breakthrough in financial engineering. And it's going to be so simple that you're going to be amazed that people consider it a breakthrough. But in a minute, I think you'll see why. I want to start with a piece of paper, this green piece of paper that's essentially an IOU. It's a loan. And the bearer of this piece of paper will get paid $1,000. That's what the loan promises, okay? So you can think of it as a mortgage, as an auto loan, as a student loan, a credit card receivable. Lots of different things fit into this category, or a bond. Except that it's a risky bond, meaning that there's a chance that whoever issued the piece of paper to the holder, they may not actually make good on the promise of paying back $1,000, okay? So that means that there's some risk. You might get $1,000, but you might get nothing. The piece of paper might default. And let's suppose that the probabilities are 90% you'll get paid and 10% that you won't. Now, with those kind of probabilities, you can come up with a relatively simple model of what this piece of paper is worth. What do you think it should be worth? What? $900. You got that because you computed the expected value. Or maybe it's a little bit less because maybe you need a little bit of sweetener in order to take that risk. But you probably wouldn't pay more than $900. So for very simple benchmark purposes, let's say it's worth $900. Okay? We'll come back to that later. It's not critical exactly what it is worth. Now, let's suppose that we have two pieces of paper that are absolutely identical. Both loans that pay the holder $1,000 and with 90% probability, so they're both worth $900. What I'm about to do is to take these two pieces of paper and put them into a portfolio. Now, what does that mean other than drawing a red circle around them? Well, what I'm about to do is to say that I've now got two identical pieces of paper that when I put them into a portfolio, I can then look at the portfolio as a separate and independent entity and then issue obligations on this portfolio, okay? Now, before I do that and talk about how I do that, let me ask you, is this piece of paper particularly attractive? I mean, would you pay $900 for this piece of paper? How many people would pay $900? 3? 850? 800? Okay, fine. So I'm getting some action here. By the show of hands, it's clear that this is not a particularly attractive investment opportunity. I mean, you know, if you pay $900 and you get $1,000, that's a 10% return. That's a pretty good return nowadays. But the problem is you don't get 10% for sure. Sometimes you get 0, right? So you've got to think about that. Okay. what I'm going to show you is with the magic of securitization, I'm going to be able to do something that nobody's been able to do before this innovation occurred, which is akin to the following analogy. You've often heard that the children of two ugly parents are rarely attractive, right? It doesn't apply to anybody here, of course, but what I'm going to show you is that I'm going to create two children from these two ugly parents, one of whom will be a beautiful supermodel, and the other will be a deformed Quasimodo. And that will be the magic of securitization. So let me show you how we do this. I've now got a portfolio that owns these two pieces of paper. And I'm going to assume that these two pieces of paper are statistically independent. In other words, whether or not one defaults has no bearing on whether the other defaults. Okay? They're two separate coin tosses, each with a probability 90% of heads, 10% tails. Okay? Once I make that assumption, and I'm going to come back to that assumption later, that's going to be key, so keep that in the back of your mind. Once I make that assumption, it turns out that I actually can figure out the statistics of this portfolio completely. And here it is. The portfolio has three possible economic values. It's either worth $2,000 if both of the loans pay off, or it's worth nothing if both of the loans default, or it's worth $1,000 if only one of the two pays off. And the probabilities are given right there, 81% because with 90% chance, each of them pays off, and if they're statistically independent, then 0.9 times 0.9 is 0.81. And similarly, if both of them default, the chances are 0.1 times 0.1, which is 0.01, so there's only a 1% chance that this thing is worth 0. Okay, now that I've got the statistics of this portfolio down, I can then engage in the magic of securitization. And here's how securitization works. With this portfolio as the asset that backs my two new pieces of paper, I'm going to issue now two new bonds. And the bonds are nothing more than claims on the portfolio. Okay? The blue bond pays the holder $1,000 based upon the results of this portfolio. So as long as this portfolio is worth at least $1,000, that blue bond will make good on its promise. The orange bond is the same thing. It has a face value or payoff of $1,000, but it's a different color for a reason. It's a different color because it's junior to the blue bond, meaning the orange bond is second in line. The blue bond has to be paid first before the orange bond can get its payment. And that's part of the contractual agreement. So I've created two different securities by simply changing the rules and using these two green identical securities as the underlying collateral or value for this set of claims. Now, why is this such a big innovation? Well, let's see. The probability of the blue bond getting paid is what? Well, it's whenever that portfolio is worth at least $1,000. And there are two states of the world where that portfolio is worth at least $1,000. Either both of the green bonds pay off, or one of the two green bonds pays off. And the probability of those two events occurring is 99%. The blue bond pays off 99% of the time. It's got a 1% chance of default. What about the orange bond? The orange bond, on the other hand, has a 10% chance of getting 0, but then also another, 1% chance, and then 18% chance. It's got a 19% chance of defaulting and getting 0. Because the only time the orange bond gets paid $1,000 is if both of the green bonds pay off, right? So the the orange bond is much, much riskier than the blue bond. And the blue bond is much safer than either the orange or the green bonds. The blue bond is that supermodel I was talking about. The orange bond is that Quasimodo that nobody wants, right? Well, almost nobody. We'll find a home for it in a minute. Now, let me tell you why this is significant, why this is such an innovation. In order to do that, I need to tell you a little bit about the bond market in particular the corporate bond market, and how risky or safe these are. And Moody's will rate bonds in different categories depending on how risky they feel the bond is. So the rating categories are AAA, AA, single A, BAA, BA, and B. And the AAA bonds are the safest, the best bets. AAA bonds almost never default. 5 years after they're issued, the default rate is something like 0.02%. After 20 years, if you wait long enough, then the default rate for AAA bonds is about 2.5%. Okay? What that tells you is that the blue bonds that I just created, they're very similar to AAA bonds, aren't they? They only default 1% of the time. On the other hand, those orange bonds that I created, they default 19% of the time. 19% corresponds to something like BA. The BA component of corporate bonds ends up being very risky. And by the way, they're so risky that certain entities like insurance companies, pension funds, money market funds, they're not allowed to buy them. They are known as below investment grade. Anything below BAA, by law, cannot be used as an investment if you are an ERISA pension fund. So what have I done with the securitization? I've taken two relatively unattractive green bonds, and I have created two new bonds, one of which is incredibly attractive, and another of which is really, really risky. Now, I need to tell you one more piece of information before we go to the net logical conclusion of why this is such a big deal. Even though a 1% default rate is pretty low, there are certain institutions that still cannot bear that kind of a risk, like a savings bank or a money market fund where they want to protect principal. Even 1% is too much of a risk. So the geniuses that came up with this idea said, you know what, we have a solution for that. What we're going to do is we're going to buy insurance for you on these 1% AAA bonds. The insurance will guarantee that in the event of default, in the unlikely event of default, the insurance company will pay you back the principal. How about that? And to make sure that this is a really serious and believable insurance contract, we're going to find a very big, very stable, very well-known insurance company, like, I don't know, how about AIG? So we now have even better than AAA securities. We've got securities that have a 1% chance of default, but on top of that, we've got AIG backing them, so the probability of default is even less than 1%. What's the chances that AIG can go under? My God. Now, you see where I'm going with this. This innovation has taken two relatively unattractive green bonds and has created a huge market for this kind of security. Who's going to buy this? Well, insurance companies, pension funds, money market funds, sovereign wealth funds, retail investors. Huge demand. We can now tap in to the demand that is latent in the financial marketplace. But wait a minute, what about these? Who's going to buy these Quasimodo bonds, these really risky bonds? Well, it turns out that in the last 20 years, a market has grown for that too. And you know who those buyers are? Hedge funds. Why? Because hedge funds are looking for a lot more action. They want investments on steroids. They don't want to earn 5 or 10%. That's not of interest to them. They want to earn 15, 20, 30%. But you can't earn that kind of money unless you take lots of risk. That's a lot of risk. How much risk? Well, let's do the math. What's the pricing of these securities? Well, we can work it out. We've got the probabilities and we've got the payoffs. So just using plain old expected values, look what you get. The blue bonds are worth $990. That's a very high price given that you're going to be paid back $1,000, right? So you're not earning much of a return. But on the other hand, look, you're not taking much risk, because it's only got a 1% chance of default, and with super senior protection, you've even got less risk. On the other hand, look at the orange bonds. The prices for those are $810. If you invest in one of those, and you happen to get lucky and your bond pays off, you've made a 20% rate of return. That's a pretty nice return, right? Yeah.
Can you pile those in a portfolio and do iteration again?
Absolutely. And you know what you get there? You get something called a CDO squared. And believe it or not, those were marketed as well. Because why not?
Because you have better return.
Exactly. And so you get the weird phenomenon that with a pool of green bonds that are absolutely identical and not particularly attractive, you can actually create a huge supply of AAA securities.
You assume them uncorrelated.
If you're assuming that they're uncorrelated, right. So that's a big assumption, isn't it? We're going to get to that. So now let me tell you about the crisis. This same anonymous risk manager at The Economist, in that same article later on, he writes about what happened to this bank during the crisis. In May of 2005, we held AAA tranches, expecting them to rise in value, and sold non-investment grade tranches, expecting them to go down. But the reverse happened of what we had expected. AAA tranches went down, and non-investment grade tranches went up. Imagine that. Resulting in losses as we marked the positions to market. And then he goes on to say, this was entirely counterintuitive. We couldn't understand it. It was really bizarre. Well, I'm about to explain to you just how counterintuitive it was. It's actually quite simple with this example. Suppose that the assumption that these two green bonds were statistically independent, suppose that we were wrong. Suppose that the correlations were not 0, but they actually were 1. Now, you might ask, why should the correlations go up? If you think of these green bonds as mortgages on various homes, why should the default in Stockton, California have anything to do with defaults in Miami, Florida, or Reno, Nevada, or Phoenix, Arizona? They should be independent, roughly speaking. That's if the housing market is going up. If the national housing market is declining, well, then you can see how those correlations might change. Now, let me show you a little bit about the housing market, and then we can get to the point of this. For a period of about 50 years, US housing was right around 110. And somehow, during the late 1990s, something happened and things took off. The housing market went nuts. And if you ask the question, how far would this real index have to decline in order to get us back to that 50-year steady state average, you're looking at a 45% real drop or a 35% nominal drop from the peak of the housing market. Okay? Now, I'm going to show you what happened to housing over the last 20 years using a nominal index. This now does not account for inflation. This is the S&P Case-Shiller 10-city housing market for the last 20 years, from 1987 to 2009. And you can see that except for a little blip in 89, 90, the housing market pretty much rose continuously until June of 2006, and then started its decline. And where are we today? The most recent observation, which is 2 months lag because housing markets tend to be less liquid, we don't have as good data, we're here, and so the housing market has come back a little bit, but if you look at the drop from the peak to the trough, we actually have dropped about 33%. So we're now finally back down to about where we've been. And in fact, the futures market that shows where financial prognosticators predict where we'll be suggests that there'll be some additional recovery. So if you've been looking to buy that vacation home, now may be a good time to look. But the point of this is that when we are on a roller coaster ride going up, well, the correlations of defaults don't have anything to do with each other. But when we're going down by a lot, the correlations can go up. And if you ask the question, well, gee, how come people didn't figure this out? Well, suppose you're sitting here in 2006, and you're looking back 20 years. If you use 20 years of historical data, there's no period in US history during those 20 years where correlations were significant. All right, now let's go back to the correlation example. Suppose that these two green loans are not only not independent, let's say that they're perfectly dependent. If they're perfectly dependent, then there are only two outcomes, either 0 or 2,000 for the portfolio. In that case, the orange and the blue pieces of paper, they have the same probability of default. What does that mean? That means that the blue piece of paper, which we thought was 1% default rate, is actually now 10%. The default rate for those blue pieces of paper, those supermodels, has increased by a factor of 10. On the other hand, those lucky hedge funds that wanted to take on lots of risk, they thought they were taking risks of 19% default, but actually, in the end, the default rates went down to 10%. So this increased correlation has the following bizarre effect. For the blue pieces of paper that we paid $990 for, we just lost 10% of our investment. It's now worth $900. Those orange pieces of paper that the hedge funds purchased for $810, they just made 10%. Because in this regime, where the correlations go to 1, where you have phase locking behavior, in these regimes, both pieces of paper are worth the same. So the AAA stuff lost money, and the BA stuff made money, and the banks, insurance companies, money market funds, hedge funds, they all exhibited these kinds of losses and gains over the course of the last couple of years. That's where the financial crisis came from. It was financial innovation pumping huge amounts of money into the housing market using these kinds of technologies, and CDO squareds, taking the bad stuff and repackaging it again and again and again. And after a while, it became so complex that nobody really understood what they had and what it was worth, because the market ultimately broke down. Okay, that's where we are today. Now, let me turn to the second theme of my talk, which is, what do we make of it? How do we explain beyond this where crisis comes from? And to do that, I actually would like to focus on crisis in other industries besides finance. In particular, in technology-sensitive industries. It turns out that in 1984, a sociologist by the name of Charles Perrow came up with an explanation, which he developed in a book called Normal Accidents. Perrow said that accidents in technology-intensive industries not only can happen, but in fact will happen with regularity because of two things. Perrow identified complexity and tight coupling as the preconditions for normal accidents. Complexity meaning nonlinearities, and tight coupling meaning multiple stages of a process which depend intimately on prior stages executing correctly. And he didn't look at financial services, but he looked at chemical industries, nuclear power plants, the space program, and in all of these industries, he identified these two conditions as contributing to it. Now, question, how complex are these blue and orange pieces of paper, these collateralized debt obligations? Well, this is a chart that was issued by the FDIC that describes all of the elements that you need in order to issue a collateralized debt obligation. You need a mortgage broker, lender, borrower, servicer, issuer, trustee, underwriter, rating agency, credit enhancement provider, and investors. That's a lot of moving parts. Pretty complex. But what's even more complex is the regulatory environment that we operate in. And let me give you an illustration of that. Does anybody recognize what that is? Any guesses as to what this is? Well, let me tell you, because I don't think in this audience we have any regulators or bankers. This is paragraph 624 of the Basel II Accord for how to compute the appropriate amount of regulatory capital you need to maintain as a bank. Yeah. Now, obviously, in this audience, equations like this don't faze anybody. But remember that the folks that are supposed to be implementing this are not PhDs in nuclear physics. They're accountants, lawyers, clerks. They're not dumb, but they're not trained to understand nonlinear dynamical systems and how they can interact in surprising ways. But I would argue that the two conditions that Perrow outlines, complexity and tight coupling, is not enough. We actually need one more. And the condition that I've added to this is the absence of negative feedback over an extended period of time. Because ultimately, and Perot doesn't really go into why normal accidents occur, he just outlines the conditions under which they do. I would argue that it's really human behavior that ultimately causes these kinds of accidents. And human behavior is such that over a period of time, if nothing bad happens, we ultimately end up underestimating the risks of the system. And we become complacent about the risks that we're taking. And I'll make that argument more precise in a few minutes. But the argument here is that human behavior, not just of investors, but of managers, of legislators, of regulators, of credit rating agencies, all of us participated in some extent to this crisis. When we are focused on one aspect of our environment, our brain works in tremendously sophisticated ways. It actually filters out everything else, as it should, because our brain doesn't have infinite capacity. And so in order for you to focus on one thing, there's a cost to that. You can't focus on something else. We now, I think, understand that human behavior has limitations. And in particular, when you're focused on profitability, maybe, just maybe, you might not be focusing as much on risk. I'm going to ask each of you to imagine that you are the chief risk officer of Lehman Brothers. And I'm going to imagine that it's 2005. It's before the crisis. And I want to suppose that you knew in advance that the housing market was headed for a downturn, and that Lehman Brothers, with its extraordinary exposures, would be very, very poorly positioned for that kind of an outcome. What would you do about it? What could you do about it as chief risk officer of Lehman Brothers? Now, I don't know anything about Lehman Brothers, so this is not inside information. I have no idea what actually happened. But let's just do the thought experiment. Suppose that you knew that the real estate market was headed for trouble and there was going to be some dislocation. And by the way, this is not as unrealistic a thought experiment as you might think, because in January of 2005, Bob Shiller was quoted in CNNmoney.com as saying that there was a real estate bubble. In September of 2005, yours truly was featured in the New York Times in an article that there was a hedge fund shakeout that was coming, that we detected some significant dislocation that was about to occur in the hedge fund industry. And so there was publicly available information, at least from academics. Raghu Rajan, others have published papers in 2004, 2005, and 2006 that there are problems coming. And suppose that you believed it, what would you have done? Well, let's go down the list. You might have approached the CEO to whom you report, Dick Fuld, and you would have said, Dick, I really think that we ought to shut down the mortgage business because we've made a lot of money and that's all great, but based on what I've heard and what I've read, we're headed for a disaster of epic proportion. So we've got to get out while we can. You know what he would have said to you? He would have said, let me see if I understand. You want to shut down the business that has been the most profitable among all our businesses for the last several years, that has produced record earnings for our company and shareholders, and that accounts for a significant fraction of your bonus and mine. You want to do what? Not going to happen. Our shareholders would have a fit. Okay, so then you say, well, let's not shut it down. Let's cut it back by half. Let's take half the risk off. Well, he would have said, let me see, if we'd reduce the risk by half, we reduce the bonus pool by half, which means that the very best people in our group, the people that have already been recruited by all of our competitors and who are already thinking about leaving to start their own hedge funds and taking half of our clients with them, now they're really going to leave. We're not going to do that either. So finally, you throw up your hands in frustration and say, you know what, I'll take matters into my own hands. Now, I don't know any chief risk officer that actually can do this, but let's suppose you could. Let's suppose that you were actually authorized to trade on the firm's behalf to hedge the exposure in mortgages by betting against those blue and orange pieces of paper. If you were to do that in size large enough to affect the bottom line of Lehman Brothers, to really protect them from that downside, you know what would have happened? You would have lost spectacular amounts of money in 2005, 2006, and the first half of 2007, at which point you would have long been fired, and rightly so, for losing a lot of shareholder wealth. Because you don't have perfect market timing. Nobody has perfect market timing. And timing is everything when it comes to these kind of decisions. Someone once said that the difference between salad and garbage is timing. That's it. The point of this example is that the psychology of greed makes financial crisis unavoidable. I would argue that financial crises are the outcome of two factors: human behavior coupled with free enterprise. If you're willing to get rid of either one of those, you can get rid of crises. But as long as we have human behavior and we engage in free enterprise, we're going to have greed ultimately overtake our ability to manage this from a social, societal point of view. Now, just because financial crises are inevitable, and if you want more evidence, since 1974, there have been 18 national-level banking crises around the world. And the common themes among these crises are, according to Rogoff and Reinhardt, rising housing and stock markets, capital inflows, large public debt to GDP ratio, and enormous amounts of financial liberalization. Does that sound familiar? That's been our history for the last 20 years. But just because you can't avoid crises, it doesn't mean that there's nothing we can do. I would argue that you can actually do a lot to prepare for crises, because it's not financial losses that create crises. It's when the wrong people lose money. And by wrong people, I don't just mean you and me. I mean people that aren't prepared to lose money, like money market funds, like savings banks, like pension funds. When those entities take risks that they shouldn't, when they don't understand those risks, that's when crisis occurs. So let me conclude, since we're running out of time, by pointing out that there's a lot that we can do to prevent the most serious repercussions of crisis. Just like you can't rule out hurricanes, you can't legislate away hurricanes, there's a lot that you can do to reduce their damage if you're properly prepared. I have a list here of things that we can do to prepare for crisis. And the things that are highlighted in red are things that we could have done all along, that we didn't need any new legislation or new agencies to do. But we simply decided not to do them because we were making too much money and having too good a time. So I want to just highlight two items on this list, though, for this audience. One is that I've proposed in other writings that what we really need at the very outset is to create an organization very much like the National Transportation Safety Board for financial crashes, because we don't really know enough to be able to even formulate proper policy reform. We need to study every single crash just the way the NTSB does, produce a report, and ultimately allow that report to guide policy. Interestingly, the NTSB has no regulatory authority. The FAA regulates the airline industry, but the NTSB has enormous impact in being able to provide a summary of what happened, how it happened, why it happened, and what to do to make it not happen again. And in many cases, the NTSB has actually provided a very important counterbalance to the FAA when the FAA gets a little bit too cozy with the industry. That's the role that I think we need for financial regulation. The second point I want to highlight, and then I'll conclude, is that we actually need smarter regulation. We don't need more regulation, because the banking industry is among the most highly regulated of all industries. We need smarter regulation, which means we need smarter people, which means we need to invest in the knowledge base. And that's why I'm so delighted to be here at NSF, because that's what NSF does. To give you a little bit of an illustration of the lack of expertise in financial services, I did a little calculation here. I looked at the MIT report for the number of PhDs produced by the School of Engineering. And in 2007, the School of Engineering produced 337 PhDs in engineering, just PhDs. Of those PhDs, the majority were funded by government grants, NSF, Department of Defense, and so on. During that same year, the Sloan School of Management, we produced 4 PhDs, and they were paid for by MIT, not by government grants. And so what I hope we take out of this crisis is not that we need less people engaged in finance, but we need more people, smarter people engaged in finance at every level. Because over the next few years, we're going to be rebuilding the financial infrastructure that will support us for the next century. In fact, if you ask the question, where did the current regulations come from that we actually operate under today? They were written in the 1930s after the last great disaster that occurred. So for the next couple of years, we're going to be rewriting the regulations that will serve us, I hope, for the next century. And the hope is that we're going to have smarter people in this audience at that table helping to rewrite those regulations. Thank you.
Think forward. Think Research Channel.